Here's what $73.66 of silver is telling you, and why almost no one is listening carefully enough to hear it. On the morning of May 1st, 2026, silver traded at $73.66 per ounce, up 3.21% on the day, and the financial press reported this with the approximate excitement reserved for a midweek weather forecast. Slightly warmer than yesterday, chance of clouds, moving on. But the price of silver on this particular morning is not a weather report. It is a verdict, partial, ambiguous, and therefore far more alarming than a clean number in either direction would be. It is a metal that has fallen approximately 39% from its all-time high of $121.67, reached on January 29th of this year. And that collapse has occurred while the structural case for owning silver, the physical deficit, the industrial demand, the monetary uncertainty, has not deteriorated by 39%. Not by half of 39%, not remotely. When price and fundamentals divorce this dramatically, one of them is lying. The question that should consume your attention right now is which one? To answer it, you must first understand what happened in the Mariner S. Eccles building on April 29, 2026. Because what happened there was not a routine institutional exercise. It was, by any honest historical reckoning, a rupture. Jerome Powell, the outgoing chairman of the Federal Reserve, a man of studied reserve and deliberate understatement, used the occasion of his final press conference not merely to discuss monetary policy, but to accuse the executive branch of the United States of actively undermining the institution he spent 4 years defending. He said it directly, not obliquely, not diplomatically, directly. The dollar spiked on that sentence, gold rose, silver wobbled, surged, and then settled back into its now familiar posture of paralyzed ambiguity. That paralysis is not noise. That paralysis is the signal. It is the market confessing, in the only language markets speak fluently, that it has no idea how to price what just happened, because what just happened has not happened before. Not in this configuration, not in this combination, not in this century. The Federal Open Market Committee voted 8-4 to hold the federal funds rate steady at its target range of 3.5 to 3.75%. That rate decision surprised precisely no one. Prediction markets had priced in a 100% probability of no change. What no model had assigned meaningful probability to was the internal fracture the vote count revealed. 4 dissenting members, the most since October 1992, a full 34 years ago, each registering formal institutional objection to the committee's direction, though notably not all in the same direction. 3 dissenters, Cleveland Fed President Beth Hammack, Minneapolis Fed President Neil Kashkari, and Dallas Fed President Lori Logan, pushed back against the statement's easing bias, the language suggesting the committee's next move is more likely to be a rate cut than a hike. They wanted that language excised. They believed it sends a dangerously accommodating signal into an economy where inflation has not been tamed, where oil above $95 per barrel is transmitting through every layer of the supply chain, where the March Consumer Price Index came in at 3.3% year over year. And a 4th dissenter broke in the opposite direction entirely, arguing the committee should have already moved toward cuts, that first quarter GDP tracking at just 1.2% annualized by the Atlanta Fed's GDP Now model is alarming enough to justify easing now, inflation be damned. Think carefully about the geometry of that disagreement. You have 8 members occupying an institutional center, holding steady, waiting for more data. You have 3 members to one side arguing the center is already too soft on inflation. You have 1 member to the other side arguing the center is already too hard on growth. The 8 are not a coalition built on shared conviction. They are a coalition built on shared reluctance to commit. And at the center of the most consequential monetary institution on earth, shared reluctance is not a policy. It is a postponement dressed in the language of patience. Now layer atop that arithmetic the specific gravity of Powell's personal declaration. He confirmed he will remain on the Federal Reserve's Board of Governors after his chairmanship expires May 15th, citing an ongoing Inspector General investigation into Fed headquarters renovations, now held by the Department of Justice. And then he said something that no sitting Federal Reserve chairman has perhaps ever said at a public press conference in the institution's 112-year history. He said, "The actions of the administration are undermining the Federal Reserve." The dollar spiked. Gold rose. Silver wobbled and settled. The market, in its imperfect and often crude way, was attempting to price a statement that carried simultaneous and irreconcilable contradictions. Powell staying signals institutional resistance to political pressure on rates. Hawkish, dollar positive, silver negative. Powell staying also signals that the Federal Reserve is under genuine political siege. Bullish for hard assets, silver included, because monetary institutions under existential stress historically drive capital toward things that governments cannot print. Both readings were correct. The market tried to price both simultaneously and arrived, inevitably, back near where it started. If you are watching silver at $73.66 today and dismissing it as a quiet day in a volatile metal, you are missing the most important part of the story. Silver is not quiet because nothing happened. Silver is quiet because too much happened, and none of it pointed unambiguously in a single direction. That is a very different kind of silence. It is the silence before a decision, not the silence after one. And the decision that is coming will not announce itself with advance warning or a diplomatic press release. It will arrive through a set of mechanical forces already in motion inside the exchange where silver's paper price is set. Forces that the financial press has almost entirely failed to explain to the people who most need to understand them. Stay with me, because what is happening at the COMEX right now is the part of this story that changes everything. There is a building in Lower Manhattan that houses a remarkable contradiction, and that contradiction is about to be tested in a way it has not been tested since January of this year, which was itself unlike anything seen in modern memory. The COMEX, the commodity exchange, the futures market where silver contracts are traded and ultimately where physical delivery is negotiated, currently holds 76.88 million ounces of registered silver. Registered silver is the metal immediately available for delivery against futures contracts. It is the physical bedrock upon which the paper silver market rests. Against that 76.88 million ounces sits 575.5 million ounces of outstanding open interest. Futures contracts representing claims on silver that, in theory, could be converted into demands for actual metal. The coverage ratio between these two numbers sits at 13.4%. Below 15% is where COMEX analysts define stress territory. The coverage ratio has sat below that stress threshold for 6 consecutive months without improvement. 6 consecutive months of a system that exists on the premise of adequate physical supply, operating with what can only be described as inadequate physical supply. To understand what this means in human terms rather than mathematical ones, consider what happened in January 2026. In a single week, 33.45 million ounces of silver were withdrawn from COMEX registered inventory. That represented roughly 26% of the entire deliverable pool disappearing in 7 days. The registered inventory was never refilled. It is smaller entering the May delivery cycle than it was before January's drawdown, and on April 30th, the May 2026 COMEX silver contract reached first notice day, the date by which traders holding long futures positions must either take physical delivery or roll their contracts forward into a later month. As of April 27th, 26,963 May contracts remained open, representing 134.8 million ounces, against that registered pool of 76 to 80 million ounces. Each 1% increase in the delivery rate on the May contract above historical norms requires an additional 5 to 6 million ounces of registered metal. The May delivery cycle does not need to replicate January's historic intensity to be consequential. It simply needs to run at a slightly elevated delivery rate, sustained over several days, into a registered pool that has not grown. That is the mechanism. That is the spring that is coiled beneath the paper price of $73.66. The financial press reports the spot price. Almost no one is reporting what is happening to the physical infrastructure that determines whether that spot price retains any relationship to reality. This physical tightness does not exist in isolation. It is the surface expression of a deeper structural fact that the World Silver Survey 2026 has now confirmed in writing. The projected shortfall for 2026 alone is 46.3 million ounces, the 6th consecutive year of structural deficit between mine supply and total demand. Since 2021, approximately 762 million troy ounces have been drawn from above-ground silver stocks globally. That number does not reverse because paper markets are confused. It accumulates, quietly, irreversibly, with the patient indifference of arithmetic. Beneath the confusion of the paper market, something quite different is occurring in the physical one. China imported 836 metric tons of silver in March 2026, a record. Chinese retail buyers are not purchasing silver on the basis of FOMC minutes or Federal Reserve political drama. Solar panel manufacturers do not acquire silver on sentiment. They acquire it because their production lines require it. AI data center construction, semiconductor fabrication, green energy infrastructure. These are structural demand sources that do not pause when markets become confused about monetary policy. They simply continue consuming a metal whose annual production cannot keep pace with what the world increasingly requires of it. This is the context in which the COMEX's 13.4% coverage ratio must be understood. It is not a number that exists in a vacuum. It is the ratio between the paper promises made in a system built on the assumption that most people would never ask for their metal and the actual physical metal available when they do. In January, enough people asked. The pool shrank by 26% in a week and never recovered. Now, as the May contract passes first notice day, the same question presents itself again, against a smaller pool, in a market carrying more monetary uncertainty than it has seen in 34 years. Here is what makes this moment genuinely different from the financial noise that surrounds it. The Senate Banking Committee voted on April 30th to advance Kevin Warsh's nomination to lead the Federal Reserve, sending it to the full Senate for a confirmation vote expected in the week of May 11th. Markets broadly believe Warsh carries a greater propensity toward rate cuts than Powell, a belief shaped by his Senate testimony and by the political context of his appointment. But consider the institutional complexity this creates. 3 of the 4 members who dissented on April 29th did so specifically to resist the easing bias that Powell's majority maintained. Those 3 members, Hammack, Kashkari, and Logan, will now serve under a chairman who markets expect to be more accommodative than the chairman they just pushed back against. Warsh arrives to find organized resistance already assembled inside his own committee. And Powell, occupying a governor's seat with a term running to January 2028, will sit at that same table as a voting member, watching. This is not your grandfather's Federal Reserve. This is something new, and the price of silver at $73.66 is the market's current best guess at what something new is worth. That guess is about to be tested by GDP data, by delivery mechanics, by a confirmation vote, and by a geopolitical variable that monetary policy cannot touch, and that remains the single most powerful catalyst for silver in either direction. If you are finding this depth of analysis useful, and you sense, as I do, that we are standing at the edge of something significant, subscribe right now, because the next 72 hours of data will either resolve this tension or compress the coil tighter, and you will want to be here the moment that resolution arrives. The analysis will not wait, and neither will the market. There is a phrase that historians use when they wish to describe something catastrophic that did not announce itself as catastrophic at the time. They call it a hinge moment, a point at which the axis of events rotates, imperceptibly at first, and then with a velocity that leaves contemporary observers struggling to explain how they failed to see it coming. We may be standing at one now, and the specific coordinates of that hinge are these: $73.66 silver, a COMEX coverage ratio of 13.4%, a Federal Reserve fractured into 3 directional camps, a departing chairman who publicly accused the executive branch of undermining his institution, a nominated successor advancing through Senate confirmation, a Strait of Hormuz still closed, and a first-quarter GDP print that, when it arrived on the morning of April 30th, landed not with the clarity the market craved, but with the precisely timed ambiguity that the market most feared. The Atlanta Fed's GDP Now model had been tracking first-quarter 2026 growth at approximately 1.2% annualized, down from over 3% as recently as late February, with fourth-quarter 2025 revised to just 0.5%. These are not the numbers of a resilient economy absorbing an energy shock with equanimity. These are the numbers of an economy that was already slowing when the Strait of Hormuz closed and oil climbed above $95 per barrel, and that has been slowing further under the compounding weight of supply-side inflation that the Federal Reserve's primary tool, interest rates, cannot cure. Rate hikes cool demand. They do not reopen naval blockades. They do not restore the 20% of global oil flows that the Strait's closure has severed. The 3 hawkish dissenters are right that keeping an easing bias signals premature accommodation of inflation that has not yet retreated. The dovish dissenter is right that tightening further into a near-stagnant economy courts recession without addressing the underlying price pressure. And every one of them is constrained by the same reality. None of them can reopen that strait. Jerome Powell understood this at his final press conference with a clarity that his characteristically careful language only partially concealed. He confirmed that a substantial portion of current inflation is attributable not to excess demand, but to energy price transmission through the supply chain, driven by a geopolitical disruption. He called it categorically different from the demand-driven inflation of 2021 and 2022. He said that if the energy situation were to normalize, if the strait were to reopen, the inflation picture would look quite different. That is, translated from the careful language of a central banker in his final professional hours, a conditional promise. The tool being used was designed for a different kind of inflation than this one, and the man who wielded it knows it. Against this backdrop, 3 scenarios emerge for silver, and each deserves honest description rather than optimistic packaging. In the first, the GDP data and subsequent economic readings prove stronger than feared. The 3 hawkish dissenters find their position validated by data. Warsh, upon confirmation, discovers that the economy's resilience constrains the rate cutting he was expected to deliver. Real yields hold firm. The dollar maintains its strength. Silver revisits the low to mid $70 range and holds there while the physical deficit story continues to percolate beneath a paper market that has not yet chosen to pay attention to it. The coil stays compressed. Patience is tested with a ferocity that only those who have held conviction through sustained uncertainty can fully appreciate. In the second, the GDP confirms what the Atlanta Fed's model has been forecasting: growth near or below 0.5%, possibly negative. The stagflation trap closes fully in official data. The single dovish dissenter's argument gains sudden, uncomfortable credibility. Warsh's accommodative reputation gets priced in aggressively ahead of his first meeting. Real yields decline. The combination of weak growth data, dovish Fed expectations, and COMEX delivery pressure creates a multi-vector bullish catalyst. Silver breaks above $78, and the distance to $85 or $90 becomes a matter of when, not if. The compressed coil releases. The physical deficit story that the paper market has been ignoring for 6 months suddenly becomes the only story anyone wants to discuss. In the third, and what carries perhaps the highest near-term probability, the data lands in the ambiguous middle. Not strong enough to validate the hawks, not weak enough to force the doves. Warsh arrives and delivers deliberately neutral opening statements, emphasizing data dependence and institutional independence, committing to nothing specific. The 3 hawkish dissenters continue their descent through regional Federal Reserve speeches. Powell, as governor, watches, occasionally speaks, and reminds the market by his very presence that the institution he defended is still under the pressure he publicly named. Oil holds between $90 and $100. Inflation holds between 3 and 3.5%. Silver trades between $70 and $80. Every approach to $80 is sold by those who believe rates stay elevated. Every approach to $70 is bought by those who understand that 46.3 million ounces of annual deficit does not simply evaporate because paper markets are confused. History has a way of revealing its turning points only in retrospect, which is both its greatest mercy and its most persistent inconvenience. Those who lived through August of 1971, when Richard Nixon closed the gold window and severed the dollar's last formal connection to precious metals, did not experience it as a civilizational inflection. They experienced it as a Sunday evening television address followed by a Monday morning with slightly different financial conditions. The magnitude accumulated over years, through the inflation of the 1970s, through Paul Volcker's brutal corrective, through the long dollar hegemony that followed. What felt like noise in the moment became signal in the history books. We cannot know with certainty whether Jerome Powell's final press conference as Federal Reserve Chairman will occupy a similar place in the chronicle of American monetary institutions. But we can observe with precision what it contained. A 4-dissent FOMC vote, the most fractured result since 1992. A departing chairman who chose to remain on the Board of Governors specifically to resist what he characterized as executive branch interference. A nominated successor advancing through confirmation with markets expecting a fundamentally different policy temperament. A physical silver market running its 6th consecutive annual deficit, with the COMEX registered pool covering only 13.4% of outstanding paper claims. And a metal that has fallen 39% from its January high, while the underlying structural demand story, Chinese imports at records, solar manufacturing consuming silver at industrial scale, AI infrastructure build-out driving electronics demand at an accelerating pace, has not deteriorated by 39%. Not remotely. The wild card above all others remains the geopolitical variable that no rate decision can address: the Strait of Hormuz. A diplomatic breakthrough, and President Trump has acknowledged that Iran has proposed conditions, including lifting the naval blockade, would pull oil towards $75 or below, collapse the supply-side inflation that has frozen the Federal Reserve's hand, and enable Warsh's Federal Reserve to cut rates at the June meeting with something approaching a clean conscience. In that scenario, silver does not reprice gradually. The compressed coil of physical deficit, Chinese import demand, monetary uncertainty, and suppressed investment capital releases simultaneously. The distance from $73 to $90 is not a forecast. It is arithmetic applied to fundamentals that have been overridden by headwinds with a specific, identifiable, geopolitically resolvable source. The honest position, the only intellectually defensible position, is the one the Federal Open Market Committee itself was forced to occupy on April 29th. Wait. Watch. Understand precisely what you own and why you own it, and resist the temptation that uncertainty always generates, the temptation to manufacture certainty where none legitimately exists. The coming days will bring May's non-farm payrolls on May 2nd, the Warsh Senate confirmation vote in the week of May 11th, Powell's formal departure as chairman on May 15th. Each represents a potential disambiguation of a confusion that currently holds the price in suspension. When that disambiguation arrives, it will not be gentle. And the people who understood exactly what they were holding and exactly why they were holding it will be the ones who were positioned to respond rather than react. Now, do you believe the COMEX physical delivery pressure this month is the most underreported story in financial markets? And do you think Powell staying on as governor strengthens or ultimately weakens the Federal Reserve's independence? Drop your honest answer below. The most consequential monetary moment in 34 years deserves a real conversation. Not a comment section full of price targets, but an actual exchange of ideas from people paying genuine attention. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.